Thank you for joining today's webinar. This is Michael Thompson, advisor at JB Markets. So today we're going to take a look at how to profit from the trade wars using ETFs and momentum. Before we do so, I just want to make sure we can cover our general disclaimer that we're not providing any advice to you. So anything we cover would be for general advice only, and the models that will be covered are based on hypothetical data derived for the system's methodology. So a bit about my background. I've been actively trading the market since 2007, and I've worked for some of the largest education companies in Australia, namely known as Home Trader and Market Informer. Both of these companies use technical analysis or quantitative approach to buying and selling. And the most important thing about using any approach is to apply risk management and money management principle. So specializing mostly in foreign markets, I do trade Australia, mostly in the US more than anything else. Now today's agenda, we're going to cover diversifying abroad, why you should consider looking outside of that. So those who are in Australia and just looking at the Australian market, consider the other opportunities outside of it. The advantage of investing in ETFs and why you should consider looking at those instruments as opposed to just individual stocks. Momentum or trend following methodology, the history behind it, and how we could use those to benefit, especially with the ETF side. When I look at the actual report itself, the report will cover the ETF report that's been sent out weekly, the strategy that goes behind it and actually drives that report. Before we do so, I'll just give a bit of background about JB Markets, which I work under. So I'm a licensed advisor that runs through ASICs and licensed through under JB Markets license. So we have a parent company called JB Financial Group that owns JB Markets, and the other subsidiary companies or sister companies are JB Alpha, which is based in Melbourne. There's Genesis, which is a prop trading firm, buys and selling using the company's money. So there's traders that trade the market actively there. And we also have a currency conversion business, which is actual physical exchange of currencies. So who is JB Market itself? We have a number of branches of our business models. Mostly we have guys or traders who are self-directed, which do their own trading and just require a platform. On the opposite side of that, the clients that want full service and execution done for them. The other side of it is we also have a managed investment, which is a hedge fund where people put money into the fund, and we do the buying and selling for our clients. That covers both wholesale and retail. The JB Market multi-asset platform is powered by CQG, which is our own platform, and we use that to clear the trades through Saxo. Now, we have a 24-hour trading desk, particularly when you're trading overseas. Those who've done that have to deal with the US dealing desk or deal with someone in the foreign time zone. It can be challenging. We have a 24-hour desk, so if you need to speak to someone regarding your trades or place an order, we have that covered. Now, diversifying abroad, why you should consider that is mostly due to liquidity and opportunity. So we'll have a look at the following chart, but you'll see the difference if you had invested in a country like, say, the US. This is based on size, market size. You can see Australia here is by far the smallest in terms of size. So if you look at even the Asian market, South Korea is almost the size of Australia. And this is only increasing in this Asian region. Shanghai, in terms of exchange, and the Japanese. So you can see the Asian markets merging to become a bigger player when it comes to size. Size also means opportunity. You can see the US by far is the largest, and then you've got the European region. So if you look at Australia, where we're certainly located remote from the other part of the world, opportunities do lie elsewhere if you've got the right methodology for that. So here's a comparison to give you an understanding, a direct relationship in terms of if you had invested. So if you have a look here, since 1989, let's say call it 1990, the red line here is the ASX. That's the Australian market. And you can see the blue line here is the US market. And the green line there is based on the German, the DAX 30, 30 of the largest companies. America represents the S&P, the broader market. Now, just from a percentage return, starting in the same period of 1989, running to where we are today, you would have had a return if you had placed 10,000 in the market and invested during that duration. You would have made 330% return. That means that you would have made 3 times, bit over 3.3 times your money. As opposed, if you place in the US market, in the same period, you would have made 10 times your money. So your $10,000 would have been $100,000 at the end of that period. And not far behind is the German market at 9.6 times your money. Now you can see the vast difference between investing in the foreign market, US, compared to investing in Australia. The difference is almost 7 times your money. So instead of ending up with 33,000, you would end up with 100,000. Now, if you imagine that compounded over many years, so investing abroad is one way good to diversify, but also there's great opportunity to be made, particularly if you're buying stocks that have a good trends, particularly in the US market. So let's first of all take a look at ETFs. ETFs, for a lot of people who are not familiar with, is really an exchange traded fund. It's listed on the stock market and it trades like a security, which means you can buy one share. You get the similarities and benefits of buying a security. And what it does is they track an index, so it's like a basket. So like an index, which we'll go through and show shortly, an index tracks an overall broad market like stocks. It also could cover commodities, cover also a bond, or any basket of assets. So it's really give the investor the ability to diversify into other asset classes other than just individual stocks. And there's more opportunities across different markets. So if you wanted to buy an ETF in, let's say, China or markets that you normally wouldn't have access to, you can through an ETF. Allows investors also to hedge their portfolio. Certain ETFs that are structured or built so that investors can actually go and buy that, and if the market does fall, they would be taking a position to manage the downside risk. The largest ranges of ETFs are really located in the US, and that's where your biggest ETF and the most liquidity, which is important if you're trying to buy a substantial or decent amount. Now, Australia has ETFs and all the other major exchanges do have them, but they originally are most liquid in the US side. Now, exchange traded funds really is not designed to outperform the market. They're really just trying to replicate what the underlying is doing. So your most actively traded stock index ETFs are the SPY, which is the S&P 500, the QQQ, which is based on the NASDAQ, the Dow Jones, the DIA. Now, normally the way they work is they would then go out, so as an index, they would go and buy and replicate the index. So the S&P 500, they normally would hold up to 90 to 100%. Sometimes they have a little bit in cash, but the idea is they'll buy that index, the individual stocks. So when you purchase them, you're buying all the individual stocks combined by just purchasing one of the shares in those ETFs. So what are the advantages? Especially if you're buying and holding a long-term investor and you want to invest in the broader market, the options is a lot of people can go to an active manager where they're trying to pick the good stocks and try to stay ahead of and outperform the market. Now, if you wanted to do that and do it yourself, be let's say your own manager and buy the broader market, by buying this ETF, you don't have the high incurring fees. So a lot of the general hit active fund managers have been underperforming because due to the lag of fees, and they haven't really done so well. So if you wanted to do that yourself, you simply buy, let's say, the SPY, and your expense, which is 0.11%, active managers can charge up to 1%, even higher. So that means that when you buy this, you buy in the broad market with a low expense, and you have a better chance of tracking along the market without the lag of expenses behind, dragging the performance down. Now it gives you access to easy exposure to stocks, like as an index, bonds, commodities, currencies, and any type of major indices in the world. Now, the great thing about that is also if you were to buy, typically if you were to buy an index, you'll normally have to go into buy futures contract. It's not going to be covered in this webinar, but the scope is that futures contract have expiration, and you have to roll the contract over. They usually last anywhere from a month to 3 months. So by buying the ETF like a stock, you can hold as long as you wish. You don't have to worry about expiration. In some cases, you'll get regular distributions of dividends paid to you by holding these ETFs. And you can also get the exposure of leverage without having to borrow. Some ETFs are structured for that. We'll cover that in another video or webinar, but in terms of you can get leverage, we have to borrow. So for a lot of funds who cannot borrow due to the mandate, this is a great vehicle for them. Now we're going to cover this particular webinar. It's going to be an ETF which is based on the NASDAQ market. It's known as the TQQQ, Pro Shares Ultra Pro Triple Q. Now it gives you exposure to the NASDAQ 100, but what it's trying to do is seek 3 times the daily returns of the underlying benchmark, which is the NASDAQ 100. It has assets under management of close to $4 billion. Now over the last 5 years, it's averaged 37.6% annually because of the multiplier effect of 3 times. Now, before we can go through a look at the strategy, we need to cover the basis of the strategy itself. Now, strategies generally can fall under quantitative, which is using data and using charts. Factual information can be derived into rules. The opposite is obviously fundamental. So with quantitative analysis, we're typically looking at models which are based on rules. They drive the decision-making process for buying and selling. Now that could be technical indicators, could be chart patterns, could even be fundamental data, provided that can be extracted and made into a rule. The huge advantage of using quantitative analysis, why I use it particularly, is also the fact that it helps remove the emotion because you're 100% systematic. You're not relying on how you feel and your decision of your state of mind, and it also removes the human biases. We tend to have a lot of biases, which if you have a look at a bit of research on investment biases, you'll find there's many biases that interfere with our decision making, and to our detriment, it usually leads to poor performance. And as a general knowledge, most people and human beings make bad investing and traders. So that's the greatest thing about that, is it allows you to structure your day and your trading decisions in a way that you're not going to be affected by that. The most common strategies used to the market really is only major 2. The third one is no more like a market maker, which we won't cover, but to give you an understanding, if you're trading the markets or investing, you're either using a momentum based trend or you're using a mean reversion, which is really buying overbought, oversold conditions, expecting it to go back to their normal prices. We'll cover the momentum obviously in this webinar. Now, to cover the momentum, we really need to talk a bit about the history of it in some aspects. We won't delve into deep detail, but you certainly can do a lot of research into this. Now, the trend following legends is really momentum fall in the same category. Is known by the Turtles. Now, this was a group of traders that were made very popular and written up in the 1980s and 90s. But the 2 teachers of that, or the 2 founders of the Turtles, were Bill Eckhart, the gentleman on the left. He was the major one. He was a person that was really debating whether, with Richard Dennis here, whether traders can be taught or simply they're born with that talent. Now, Bill Eckhart is really a professional in terms of the field of intelligence. What I mean by that, sorry, he's got a background in education and he's very intellectual. So he's argument was that people couldn't be taught, so they were born with that talent. But Richard Dennis was really of the belief that people can be taught provided they follow certain rules and they stick to them. And he believed that human beings and traits of trading can be transferred to another person. Well, long story short, Richard won the argument, and over the course of the two groups they brought in, made them millions of dollars, and a lot of articles, even books were written about them. So really, the approach to it is simply, which we'll cover shortly, is giving a set of rules to traders, allowing them to follow it, and then over the course of time, it would yield results. Now, the whole idea behind momentum strategy is not about predicting. So if you're looking at forecasts or you're looking at tomorrow's price like you've watched on TV, it's not about that. Simply it's trying to identify a trend and then take advantage of or capture that trend by jumping onto that trend. It's very commonly used by the hedge fund industry. So they'll fall under the category known as systematic or momentum based. Predominantly they're used on futures market as well as some on equity, but they're majority used in the future side. So they trade a whole basket of commodities, indices, foreign exchange. So anything that really they can put into the basket as long as it's not correlated. Now the holding period would depend on their time frame, but they're typically holding from months to years in some cases. Now the whole idea behind momentum is to buy rising trends and to sell falling markets. So if you ever short sold a market, and if you're looking to do that, this is a sort of strategy that will allow you to identify trends that are falling and will sell on the way down to profit from them, and obviously to buy as things rises. And then as the trends do change from long or let's say rising to flat or bear, you would then get out of that position. The biggest advantage as to why you would have an edge using this strategy is that it has built-in risk management. I cannot stress highly enough that while a lot of investors and traders do fail, particularly traders, that they don't cut losses. And this is built in to the strategy. You need to cut the losses and let your profits run. As simple as it may sound, this is really the cornerstone of this strategy. By allowing your profits to run and to cut losses quickly, this really builds up a profit for the strategy. Now with the ETF report we're going to look at weekly bars. Weekly bars are very important. Allow you to capture good trends, and really by using the report you don't really spend much time, really less than 20 minutes a week. Now here's a quick comparison just to give you context as to how the managed futures will perform, aka trend strategies. Now in a bull market, you'll find that everybody knows how to make money. It's the old saying, a rising tide lifts all boats. So most people right now, where we are today, obviously think that they're a genius or really good at the market, without understanding that markets do go through cycles. So what happens to your strategy, in any strategy, which for that matter, when we hit another bear market or downturn, such as in the GFC? The most important about any strategy, particularly if you're just buying for the long term or taking one direction and you don't know how to take advantage or minimize the risk on the downside, is to know how to go into cash, reduce your exposure and reduce your risk. Well, with momentum strategies, now comparison, you can see the red line here is the S&P. That's the S&P index here. And this is the hedge fund, that's HF. Now you can see these circles highlight major events in the market that's impact like downturns. You can see the most recent one, which is the one we had, the GFC. Hedge funds perform extremely well because trends to the downside are quite extreme, and they're also trading other markets such as gold, bonds. Those times when market conditions are stressed or we have a downturn, assets are floating into safer haven stocks or safe haven asset classes. So in those cases, there's some big trends to be had. For a lot of people, they see that there's only a downside. There's always opportunity in both sides of the market. There's always buyers and sellers on either side. So by incorporating a momentum strategy, you really want to do two things. If you're not taking advantage of the downside, which is one of the options, is you go into cash. So the greatest thing about that is you have the ability not only to profit, but if you don't, you protect your assets and you can then have the ability to buy back at a lower level. Now let's go look at the actual strategy. Enough we covered the theory, so let's go see how this applies. Now before I can just go through the actual strategy, I just want to highlight time frame, because time frame is really misunderstood or very well understood in terms of how it generates return. So up the top you can see here we're looking at the TQQ, which is a NASDAQ 100 ETF. The top one represents the weekly time frame, and the bottom one here represents the daily time frame. Now I applied an indicator which we use for the report, which is our reversal, the blue one there. Now that there will give you an idea of what time frame can do to an indicator. Now as you can see, each day the markets jump up and down. I consider that noise. If you're looking for good trends and you're not a short-term trader, you're looking for sustained moves in the market to capture, the daily time frame can cause a lot of signals that can occur on the indicator. Because you're looking at a smaller zoom, you're seeing a lot more movement activity. Where if you look at the same indicator up the top, which is the blue colored indicator there, you can see part of our indicator, part of the exit is when we cross over the red line. And that would be our exit. So a comparison, you can see many times those events occurred in the same period from here, which is a low of beginning of January 2019 to our peak at May. Now during that time, we had several cross of the red line there of the trigger, anywhere up to about probably 10 to 12 times before we hit the peak here. We really had two events, and just by looking at the bar itself, you can see clearly that's a lot more straighter in terms of trends to analyze and identify than compared to that. Same goes for the downside. But enough about the time frame. Let's go look at the actual strategy itself. So I'm just going to close this off and then go through the strategy. Now, some of the concepts that we're going to go through is going to be a little bit new to some people, but do stay with me. The idea behind buying momentum is to manage the risk once you buy. So we're buying. It's not the most difficult part, it's really the exit. So I'm going to focus a lot more on the exit, but I'll briefly outline how the buying is done. Because with momentum, unlike people buying value, your time frame, let's say you're buying stocks for fundamental value, your time frame could be 5 years, maybe 10 years. You're a long-term buyer. So for a lot of people buying cheap, the word cheap stocks or cheap or buying value, in momentum we do the direct opposite. So in the case of buying cheap, you'll probably try to buy as prices fall here and here. So along the way, as price is falling, you'll be looking to buy and you look to buy multiple times here. Now we don't have the luxury of that time frame of 5-6 years. In most cases, in the sense of the report, we're really looking at more of a medium-term time frame. So medium term can be defined by different people, different lengths. But when I say medium, I'm looking at 1 month, maybe 2 months, generally less than 6 months. Really depends on the trend, but on average, let's say we're looking between a few months. We want to capture some good trends and then take our profit and then reinvest it back into the market. Now, we buy when prices rise because of that time frame and also the strategy. We don't want to be catching a falling knife. So in the cases when prices are falling, we don't know if that price is going to continue to fall. Now, obviously, with someone with a 10-year time frame, 5 years, they could hold it for that long. They don't expect to cash out of it. But with momentum, we don't have that luxury, and we want to be buying the minute the price is going in our direction. So an easy example would be that if these bars are all weekly prices, the entry, as I mentioned, is not so important. So let's say we buy when the green bar catches up, we have a rising week, and we simply just buy the high. that point there. That would mean that what we're trying to buy is the direction of where the trend is, or direction of momentum. Because we want to go with the same with the buyers. Because what really the market, or any market represents, stocks, or any market you want to pick out, is buyers and sellers. So if buyers are coming in, like in the case down here in early January, it indicates that the sellers are now not in control, the buyers are, whether it be the Fed motivating the markets, saying they're going to cut interest rates, or whether the trade war talks are now back on track and Trump and President Xi are getting together to make things happen. Regardless, what it's telling us is that the price and the buyers is signifying that buying is coming in. Sellers are winding out and they're not piling into the market, because supply and demand drives prices, and this is what telling us what is factual. So when we see a rising price, it indicates momentum is in the favor of the uptrend. So we simply just want to be buying. That's all I want to indicate. So we'll buy it at a price higher than the close, or at least at or higher than the close price. So once the prices get to that level, we would then simply enter at the market, or whatever price we set it at. Once we're in the trade, the most important aspect is not so much once we are getting in, is managing the risk. And how we do so is we have three types of exits. Now the exits is something that most people don't tend to focus on, because most people want to know when to get in. When's a good time to get in? Profit and loss is made on exits. So what's important is knowing where to exit if prices are falling. Now I'm going to highlight this by outlining the multiple exits that we use. What's important to note is that cutting losses as the mantra or the cornerstone of trend following is to keep losses small and to let profits run. So the whole premise of using these indicators or exit rules is to simply do that. So how do we achieve that? Is we focus on, first of all, if we're in the wrong direction, we have a stop loss. That will get us out quickly. It doesn't get hit often, but that's our initial risk, which you see here. So this is a signal that was sent out 2 weeks ago. We got in at 57.99. Our stop was placed at 41.75. That's what I call the fail safe. And what that means is that if prices do get down and just totally breaks down, we would simply just exit. So it's set in the market as our safety net. However, what we really focus on, and one that gets us out for profit more often than not, is our reversal. So the minute we cross above the red line, that would indicate to us that the market is about to reverse back and likely to become a short downward trend. So the minute that occurs, it indicates to us we should get out for this case, Monday. So where I'm showing you is where those events occur. So with rules driven, anytime this occurs, we would exit. That's all we do. We don't have ifs or buts, we simply just get out. So the exit is predetermined. These rules are 100% executed. So there's no discretion on the part of the investor or trader here. So I'm going to overlay now to give you an idea. The last one is simply the profit band, which is the green line. That indicates that the price is extreme and we should get out. Same. So these three exit governs what we do once we're in the position, which is the most important aspect of trading or investing there. So I'm going to now apply the strategy. So we've got the rules to get in. We have the exits to get out. The management aspect is another thing we'll cover another video. So I'm just going to show now, if we apply these rules going back in time, because with any strategy, if you have rules to it, you can then go and research and test it against historical price data. Now I'm going to apply it and just show you what it will look like. Now I'm going to remove a few things so we have a bit more cleaner chart and zoom out a little bit. Okay, now highlighting profit and losses to make it easy and visually to see what occurred in history. And I'll show you the historical report as well. So here, green arrow indicates where we bought, red hollow arrow indicates where we exit. 10,000 was allocated to each time we want to buy, and we don't reinvest any of the profits. So clearly you can see during this uptrend from January, we had 3 buys. And what you'll see, which is important, is that whenever we had a loss, however, we will cut it quickly. So the bigger the green box, and the bigger the box, the wider the box, indicates how long we've been in the market and obviously how much profit we've made. We want to have big green boxes and small red boxes. Small narrow red boxes if best. So as mentioned several times, which I'll emphasize again, cutting losses here and letting profits run. So cutting losses here, letting profits run, letting profits run. Now, let's go back to an event. So the trade war's been going on for some time now. The question is, would people have bought in January lows? It'd be very extremely difficult with all the negative news. If you wind back to the beginning of the year, and where we even are more recently, where we are here, which is that low in June. So a month ago, when we had a decline in the market, could you have bought here? For a lot of people, it would be difficult. Would you have bought here? Most people would have said, no, trade talk's still interfering with the market, wait a little bit. As you can see, without having the rules, emotions and the news can drive decision making. Not to say you can't make good decisions using those events or those. If you're targeting and specializing that, and you were very good at it, then you could do that. That's more of a discretionary approach. But for the purpose of being able to consistently identify opportunities, as mentioned, it's not about predicting the trend. But what we're simply doing is, if we can find a potential trend through the research that we've done, markets will repeat themselves to some degree. Doesn't mean that the markets will consistently do the same thing all the time, but there is a consistent pattern markets go through. So like this correction that you saw in October of last year to January. Now these patterns of sell-offs repeat themselves. So let's go look at an event. Before I do that, I just want to highlight quickly that part of the trend buying momentum is that we don't catch falling knives, but we do try to get into a potential reversal. We don't know. Hindsight bias is that it's a good time to buy it here. At the time, you never know that. But this time, you can see there was one buying opportunity through that whole decline that went through over 3 months. We had only one buy, and then we only started buying again back in January. So that means that we won't be catching a falling knife, but we will be trying to get into potential new trends. As any decline occurs, markets never go through downward movements one direction. They go through what we call more of a cycle or waves. You get a wave down and you get a wave back up. So if you look at any major correction that's occurred, which will go back to 2015, early 2016, you can see here prior price action is indicated sell-off. Because we're buying in the direction of momentum, we won't be entering that. We did get one buying opportunity near the bottom or after the reversal of the bottom, which created a small profit based on the exit on the reversal indicated down here. And then we had another buying opportunity which became a big profit. And then we tried to enter it again. As you can see, red box small, another small one, there's a big profit. So you get the idea. If you're buying with the direction of momentum, you have a much better chance of being profitable. But also when you're wrong, you need to get out extremely quickly. Because it's like looking at a business and analyzing a business. Let's say, mom and pop shop or even a large business. Businesses can make money by increasing their profits or productivity. Let's assume the customers are the same. The demand is the same. If the customers are prepared to pay more for your product and you're making XYZ product, you can do one of two things to increase your profits. Cut your expenses, reduce your wages, cut the cost of manufacturing it. And if you raise your prices, let's say by 10%, 20%, and your customers are happy to pay for it because you have a unique product, you've done two folds. You've cut your cost of producing the product and you've increased your profit. That's the same thing we're doing in trading investing here. We're simply cutting our losses and we're increasing our profit margins by letting our trades run longer. And you need a methodology to do so. So now I'm going to run through and show you the actual full report. Now this report covers when this ETF was created in 2010. Most of these ETFs were created back just after the GFC. For a lot of investors want to get involved, so it became popular after that. Now you'll see this is 10,000 buying each time. Now we deduct commissions, brokerage costs, which is going to affect your trading. So you need to put realistic cost in there. $30 is deducted each side, so $60 deducted in total. And so $60 deducted, whatever's left over is our profit or losses. Now you can see every year, which I'll show you shortly, has been profitable. But what's important is that it's not always going to be profitable every single trade. No strategy ever does that. But if you have let's say, a good winning percentage of even 50%, you can make money, even lower, provided your profits are much larger than your losses, which is what this strategy tries to achieve. Now you can see there's down periods when the market conditions was not suitable, and the strategy tries to get into a position, takes a loss. And then when a new trade comes out, there's a big profit, and it makes up for 2, 3 times, maybe 4 times whatever losses we had. So ideally, you want to consistently grow the account and the strategy profitable over the long run. And this is shown so far to demonstrate that. And momentum strategy is certainly not new. You'll find that it's been in existence for a very long time. That's not for another topic, another day, but certainly if you do some research, you find a lot of academic research coming out now. But in terms of traders, it goes back as far as the rice grain traders and even people looking at candlesticks. But here's the yearly figure. So from 2010 to 2019, on $10,000, this is what the net result was. The biggest profitable year was 2010. You should expect that after a major correctional bear market. So good trends emerged from that, and that resulted in 9,000 profit. No year was a losing year, but the lowest was about just a bit over $1,500. Now where we are today, we've had 3 trades, not many. So we're not talking about thousands of trades, or even that matter 5 to 10 trades a month. Really, you're getting 1, maybe sometimes 2 in some cases, but generally 1 trading opportunity a month. So that means that these opportunities represents a potential big profit. So we're sitting on 3,000, just under 3,000 for this year, and we should expect more consistent towards the end of the year. We've got another half year to go. We should be on track maybe to do as much as last year, but there's no guarantee of obviously that occurring. But so far the market has been rallying strong and trade talk in effect. Last night we have closed higher, so trade talks are looking positive. And given this direction that we're going, it's likely to be that we could break all-time highs. I'm just going to finally wrap up with, now that's one market. Trading one particular market is never a great idea. You want to have a combination of many markets because it gives you diversification. So as a comparison, this is the S&P 100, NASDAQ 100 index. Quite smooth and generally profitable every year, and profits are larger than the losses for sure. Now let's combine, and I'll just highlight these ETFs. We'll cover them individually in other videos, other sessions, but what we'll have a look at is the asset classes. So volatility, if you haven't traded, SVXY is a volatility product. So if you're looking at volatility rising or falling, this is one of the products created for that asset class. Now, that one is also based on NASDAQ, but that's the 2% move per 1% move on the NASDAQ. And the UPRO is based on the S&P 500. So the last one is take a position on the short side. That's a volatility product, but you'll see the combination of adding these 5 there's a specific reason to add them. They're moving differently, and the entries and exit using the same model are slightly different to give the diversification approach. So I'm going to run this report. For easy calculation, it's going to be based on 20,000 each, so this is 100,000, but you can certainly do it on 10,000 each market. So 20,000 allocated to each one, and profits are not reinvested. Now I'm going to show you the end result, and this will do it for this webinar. You can see here, for the same period of 2000, and this goes back a little bit further, 2009, because some of the ETFs did start a little bit earlier than that, but there wasn't many opportunities in 2009. Most of them started around late 2009, but you can see the smoothness of this. This is the actual performance chart. So on 100,000, this is what it would have looked like in the past. And you can see during downturn, which is in October here, we were profitable because we had a position taking advantage of that using VXX as the ETF. Now the year to year, before I do that, I'm just going to give you a quick comparison again. So that's one ETF. This is all 5. Now you can see the smoothness of it, the difference between the two. That's really what diversification is all about. Running strategies that are on different markets. When one is profitable, the other one could be losing money, and you get the balance effect of a more smoother return because one is covering the disadvantage of the other, because no strategy and no markets operate the two same way if you choose non-correlation, and that's the advantage. So you want to add in as many potential opportunities which are not correlated given the capital we have. So if you were trading stocks, you don't want to be just buying bank stocks, only bank stocks. You want to buy maybe bank, materials, industrial, telecommunication. So you have a portfolio which is balanced, because when one sector or asset class is trending, the others may be lagging or not at all. Anyway, that does it for this webinar. Thank you for joining today's event, and I'll look forward to seeing you guys in the next event.